Let me tell you something nobody in the crypto space wants to say out loud. Most investors don't lose money because of bad strategy. They lose money because of a single decision made at the worst possible moment. When fear or greed took the wheel. You've seen it. Maybe you've lived it. Bitcoin drops 20%. Panic. You sell. 2 weeks later, it's back. And you're on the sidelines having locked in a loss that never needed to happen. Or the opposite. Bitcoin is up 60%. Euphoria, you put in more than you should. Then it corrects 30 and suddenly you're overexposed, stressed, making decisions you'd never make with a clear head. Here's the truth nobody wants to admit. The problem isn't your analysis. The problem isn't your timing. The problem is that you're human. And humans are not built for this kind of volatility. Our brains treat a 20% drop exactly like a predator charging at us. The stress response is real. The urge to act is overwhelming. And acting on that urge in a volatile market almost always costs you. So what's the fix? You build a system that removes the decision entirely. A fixed amount, fixed intervals, regardless of price, headlines, or how you feel that morning. That system has a name. It's called dollar cost averaging. And in the next 20 minutes, I'm going to show you exactly how it works, why it works, and how to set it up today. I'm Dax. This is Dax Crypto Lab, where analysis becomes action. Before we get into the mechanics, I want to make sure you understand why DCA exists, because this isn't just an investment strategy. It's a psychological defense system. Picture two investors, same starting capital, both buying Bitcoin. The first one, let's call him reactive, checks the price every single day. Bitcoin drops, he gets anxious, drops more. He sells to stop the pain. Bitcoin recovers and rips higher. He feels left behind. Buys back in near the top. Drops again. Sells again. He's always one step behind. Always buying high, selling low. The exact opposite of what he's trying to do. The second investor, let's call her systematic, never looks at the daily price. First of every month, same fixed amount into Bitcoin. Up or down, doesn't matter. No headlines, no Twitter, no price predictions, just the plan, executed. After 3 years, who wins? The systematic investor, every time. Not because she's smarter, not because she has better information, because she removed the most destructive force in investing, her own emotional reactions. The Fear and Greed Index exists for a reason. Extreme fear, retail is panic selling. Extreme greed, retail is buying the top. Smart money does the opposite. DCA keeps you on the right side of that equation automatically. No intelligence required. So, what exactly is dollar cost averaging? Simple definition. You invest a fixed amount into an asset at regular intervals, regardless of price. You decide how much. You decide how often. That's the entire system. When price is high, your fixed amount buys fewer coins. When price is low, your fixed amount buys more. Over time, your average entry price reflects the full range of market conditions. Not one unlucky entry at the top, not one panic sell at the bottom. Concrete example, $100 a month into Bitcoin. Month 1, Bitcoin at 50,000. You get 0.002 BTC. Month 2 drops to 40,000. You get 0.0025 BTC. Month 3 drops to 30,000. You get 0.0033 BTC. Month 4 recovers to 45,000. You get 0.0022 BTC. 4 months, $400 invested, but your average entry isn't 50,000. It's closer to 40,000 because you bought more when price was lower. That's the mechanism. The volatility that terrifies most investors actually works in your favor when you DCA. Every dip is an automatic opportunity. You don't need to time the bottom. The system does it for you, gradually, mechanically, without emotion.
Get daily crypto insights by subscribing now.
Now let's talk real numbers. $100 monthly DCA into Bitcoin starting January 2019 through early 2024. Total invested $6,000 would have grown to approximately $19,000, over 200% return. Zero analysis, zero indicators, zero headlines, just $100 every month without exception. Compare that to the investor trying to time the market over the same period. Research is brutal on this. Market timers, even professionals, consistently underperform simple DCA over 5-year horizons. Why? Missing just the 10 best days in Bitcoin's history cuts your returns by over 50%, and those 10 best days almost always come immediately after the 10 worst days. The panic sellers are always gone when the recovery happens. Here's what most people miss about bear markets. When Bitcoin is down 50% from its high, your fixed monthly amount is buying twice as much Bitcoin as it did at the peak. Every month you stay consistent during a bear market lowers your average cost basis. And when the bull market arrives, and historically it always does, that lower average cost basis turns directly into higher returns. Practical question: how much and how often? Frequency first. Weekly versus monthly. Weekly captures more price points, slightly better averaging in volatile conditions. Monthly is simpler. One decision aligned with your salary cycle. Historical backtesting shows the difference in returns between weekly and monthly DCA is less than 6% annualized over 5 years. That gap is almost irrelevant. What matters far more than frequency is whether you actually keep buying, especially during the months when everything feels terrible. How much? 3 rules. First, money you won't need for at least 3 years. If there's any chance you need it in 6 months, it doesn't belong in crypto. Second, an amount you can sustain through a 50% drawdown without panic. If the number creates stress, it's too high. Start smaller. Third, the goal isn't to get rich in 1 year. The goal is to build a position systematically across a full market cycle. $25 a week, $100 a month, compounded over 3 to 5 years. The math is on your side. Consistency beats size every single time. Here's where DCA goes from good to genuinely powerful. Standard DCA buys the same amount every interval. But there's one enhancement that professional long-term investors use: completely systematic, completely unemotional. Fear-weighted DCA. You set your baseline, say $100 a month. Then you add one rule. When the fear and greed index drops below 20, you double that month's contribution. Below 10, extreme fear, you triple it. Why does this work? Every extreme fear reading in Bitcoin's history has been followed by significant upside within 12 to 24 months. Without exception, you're not calling the bottom. You're buying more when prices are statistically cheap relative to market sentiment. And the key word is systematic. You set the rule before the fear hits, so when the market is screaming crash and every headline is apocalyptic, you don't decide in the moment. You already decided on a calm Sunday, you just execute. The 2022 bear market data is clear. Fear-weighted DCA investors who doubled contributions during extreme fear periods outperformed standard DCA by over 40% by the 2024 peak. Same asset, same strategy. One additional rule applied systematically. Now the mistakes. Because DCA sounds simple, and most people still sabotage it. 3 ways. Mistake 1. Stopping during the bear market. The most common. The most expensive. 8 months in, Bitcoin is down 40%. The news is catastrophic. Everyone is calling it dead, and you pause. Just for a few months, until things look better. Those months you skip are the highest value months of the entire strategy. The months your fixed amount buys the most Bitcoin. The months that define your average cost basis for the whole cycle. Stopping your DCA in a bear market is like turning off your sprinkler the day before rain. Mistake 2. Switching assets mid-strategy. You start DCAing Bitcoin. It goes sideways for 3 months. Ethereum is up 20. You switch. Then a new altcoin is up 50. You switch again. Every switch resets your cost basis. Every switch introduces a new variable. You end up with a fragmented portfolio and no meaningful position in anything. Pick your asset. Commit to a full cycle. Mistake 3. Setting an amount that's too high. If your DCA creates stress, if you find yourself checking the price obsessively because the number matters too much, reduce it immediately. The perfect DCA amount is the one you can run mechanically without emotional attachment. Boring is the goal. The moment DCA starts feeling exciting, you've set it too high. You're set up. Starting today. 5 steps. Step 1. Decide your amount. Monthly disposable income. The money you don't need for bills or emergencies. 10 to 20% of that. That's your baseline. Step 2. Decide your interval. Weekly for better averaging if cash flow allows, monthly for simplicity. Either works, consistency is what matters. Step 3. Automate it completely. Go to your exchange, Binance, BingX, wherever you trade. Find the recurring buy or auto-invest feature. Set it to execute automatically on the same day every week or month. Remove the manual decision. Remove the temptation to skip it. Step 4. The fear rule. Open TradingView. Search Crypto Fear and Greed Index. Bookmark it. Check it once a week, not once a day. Below 20, you double that month. Below 10, you triple it. Write this rule down somewhere visible. Step 5. Set a quarterly review date, not a daily check-in. One date every 3 months to confirm your DCA is running and your allocation still makes sense. That's the entire system. 5 steps, 1 setup, then you let time do the work. You run your own lay-bee. Next Sunday, we go deeper into portfolio construction, how to split your capital between Bitcoin, altcoins, and stablecoins, and how to rebalance systematically without emotional decisions. If this gave you a framework you can actually use, subscribe. Hit the bell. Every Sunday we build the system. Monday, Wednesday, Friday. Real-time market analysis. Questions about any of this, drop them in the comments. I read every single one and I'll answer. I'm Dax. This is Dax Crypto Lab, where analysis becomes action.